Okay, yeah, thank you. My name is Sebastian. I'll be talking about explainable artificial intelligence, XAI, and how can we use it to asset prices of the stock market. So first of all, what is machine learning, right? Usually when we hear about artificial intelligence, what we're really talking about is machine learning, which is a subset of AI. That's a technical definition of machine learning, but in a nutshell, machine learning is basically a model that starts with some sample solution. It's usually pretty bad, and then it takes small steps until it approaches an optimal solution. So let's look at an example. Say we want to balance this lever here. Where do we put the triangle? We have two ways to doing this. One, we just do the math, right? We know the torque equation, we know the forces, we just solve for this. The machine learning approach, on the other hand, will be, starting with some solution, it's not good, and then we take small steps until we reach that optimal solution. Now, I know what you're thinking, right? Like, why bother, right? Like, it seems easy enough. Well, it happens that in practice, it's usually not the case, right? These equations are often extremely complicated, right? Sometimes they don't have a closed form solution at all. Or in some cases, the variables are changing, right? For example, what if the forces here are constantly changing, so we cannot set any value beforehand? Now, that's machine learning, but what's explainability? An issue with machine learning models is that they work like a black box. So they can be extremely efficient, but at the same time, they don't tell you why. Back in the day, the question in computer vision of, is this a cat or a dog, was pretty much solved until they tested with an image like this. Now, this is clearly a cat, but it has a green background and it has a leash here, which is uncommon for a cat. So these traditional models, if they ask them, is this a cat or a dog? They will tell you it's a dog, and that's it. But if you had used explanations, right, explainability, the answer would be, this is a dog because only dogs have green backgrounds and only dogs have leashes. Now, this makes sense, right? Like, people rarely walk their cats or play catch with, their cats in the park, but we do that with dogs. So if we had used explanations here, we could have returned to the model and then fix it, because we know this is not what constitutes a dog or a cat. Now, this is important because, in my opinion, the true potential of artificial intelligence isn't becoming a tool for professionals, right? So if we have a machine learning model that can work as a tool for a doctor, for example, and then a doctor can use this model to enhance, her diagnosis and just do a better job, that will be very powerful, right? So we need explanations for doctors or any other professionals to use machine learning as a tool, just as they would use, for example, an X-ray machine or something else to just do a better job. Now, let's talk about the specific applications of explainable artificial intelligence in my thesis, right? How do we use this technology in the stock market? Our goal was to build, so understanding how a stock portfolio, right, will perform relative to one another. How stocks in a portfolio will perform is not the same as asking what is going to be the price of a stock. Now, this is very different because this is actually an easier question, right? If I give you 10 stocks, how should you allocate them to get the maximum return? The next question is, what is causing these stocks to perform better or worse in a given portfolio, right? What is the interaction of company-specific characteristics with macroeconomic trends or macroeconomic processes to cause these specific performances? So this is our model, what we built. It actually is made of two different machine learning networks. The first one is a long short-term memory network. We gathered 134 macroeconomic parameters, and we're using this network, which is very useful for time series analysis, right? So this is data that the result is influenced not by the immediate input, but also from what happened a few time series steps ago. We also use this network to reduce the dimension of the macroeconomic data from 134 to 8 characteristics. And the second network that we developed is a feed-forward neural network, which combines the firm-specific data with the macroeconomic data to provide the portfolio weights. Now, the portfolio weights, they can be positive or negative, but they definitely suggest to you how should you allocate those stocks. If you have a negative value, what this is telling you is that you should sell that stock now and then buy it when it's cheaper and make money on that difference. If it's positive, it's just telling you buy this percentage now and then sell when it's worth more. Now, take a look at this picture for a moment and trying to find a pattern. It is actually a very simple pattern hidden here, but it turns out it's mostly impossible for humans to do this. This is actually just a time series difference of a sine function. Now, what you see here in orange is how the model is the pattern that the model found from the previous data. So what this is highlighting is that our first model, the LSTM model, is actually able to abstract patterns from time series data in a very powerful way. And as you can see here, what it's doing here is finding how this pattern moves, and it's using the 12 previous data points. So for every orange point, we're using the 12 previous data points. In practice, that would be like using, the last 12 months of some macroeconomic data. If we use a smaller look back period, like 4 months, you can see the accuracy greatly dropping, although there's still some intention of detecting the pattern. So that was with the simulation data. With real data, some of the things you can see here, I guess what I want to highlight here is that you do see that the model is abstracting some cyclic behavior on macroeconomic data, which is what you would expect because, macroeconomic processes are full of cycles that tend to be with the overall economy and, sometimes with more country-specific events. That takes us to firm-specific characteristics. So we want to know if the model can extract how firm-specific data is interacting with one another. So what we do here in the left is a model of two characteristics, right? X1 and X2, working in a multiplicative way, right? So they are contributing to the return by multiplication. And what you see here to your right, it's a completely machine learning generated picture, right? So this was completely generated by the machine learning model. And what it's showing is that it's able to detect that these two specific characteristics are working by multiplications, right? The way they interact is through multiplication in this way. So let's look at real life results. What we're observing here is data from August 1999 to August 2002. That's right before the dot-com bubble crash and right after. So as you can see here in orange, the S&P lost like 31%, which is pretty bad. And what you see in green is some 500 stocks suggested by our model, right? So just buying evenly without any concern of portfolio weights, but just buying the stocks recommended by the model gives you actually pretty good results, particularly for a time of a crisis. The next step, actually, what you see in blue is our complete model. So this is not only buying the stocks recommended by our model, but also weighting them as recommended by our model. So that means that the way you are allocating these firms, the percentages that they represent in your portfolio, are used follow what the model suggests here, and you see a return of almost 155% in that 3-year period, while the market overall was actually crashing. Now, there are some caveats here. First one, the model is just trying at this point to maximize the return, right? So we don't have any of the particular or the typical trading or hedging strategies that you could use. We're currently working on measuring some of the risk metrics like the Sharpe ratio or the beta of our model to understand how these perform in those metrics. The other thing here is that, as I mentioned, this is a long-short portfolio. So that's what you will do in practice. What it's doing is that it's buying some stocks and making money if they go up, and selling some stocks and making money if they go down, while the S&P is just a long portfolio. So it's just, you would just make money if it goes up. Now, in a particular period of a crisis, right, it's expected that a long-short portfolio like ours would perform better. And finally, our model is rebalanced monthly. That means that every single month we are rebalancing what firms are in our portfolio, and also by what weights in the case of the blue line. And in practice, they give you some liquidity concerns. If you have you're managing a lot of money, it might not be feasible to get in and out of your positions like that, and that can also bring some brokerage fees. To conclude, I just want to point out some of the characteristics and one of the most important characteristics. So our model is telling us that the most important firm-specific characteristics turns out to be last month returns, the explained volume, and the net operating assets. And now that's great because that's what you would expect a trader or investor to be most interested on when they're investing. However, on the macroeconomic characteristics, the argument is a little bit more subtle in the sense that the median spread kind of refers to the overall volatility of the market, and that makes sense. But the other two macroeconomic characteristics, although they're definitely very important, they're not the most popular ones, right? And it's interesting, it'll be interesting to further understand why we're not seeing things like the treasury yield or the AAA rates here instead of these lesser known characteristics. Yeah, thank you very much. I'll want to thank the grants that made this possible, and I'll take some questions if there are any.